Hello and welcome to a new episode of the Sebastian Show. In today's video, we have a really exciting video because I have some amazing news to share about one of my great companies that is continues to outperform the market and continues to deliver every single quarter and defying all the expectations that has been set on the company. And the company I'm talking about is currently my largest holding, because of the recent gains that it has gone through. And the name of the company is Deckers Outdoor. And in this episode, I would like to talk a little about my position in this company, my thesis, and why I believe this company will be such a great market beater and continue to beat the market as it has done in the past 10, 5, 3 years. Every single time frame they've continued to beaten the index and outperformed many great companies that are known brands such as such as Nike and other great companies. So yeah, I'll take a little I will take you guys a little through my thesis on this company and why I believe this company will continue to take market share over companies like Nike, and how this company has grown to be such a astronomous and incredible market beater over time. For those that don't know, Deckers Outdoor is a household brand name that has known brands such as Uggs, such as Hoka, and other brands that are really popular in the retail industry. And they have continued to perform very good year after year because of the continuing to buying brands and continuing to growing them. One of these examples is the Hoka brand that they bought back in 2011, and they have grown this a brand from a really small brand into an incredible market leader and the competitor to other no names such as Nike and Adidas and other shoe brands in the sports niche. So this is a graph that shows one of the incredible growth stories that Deckers Outdoor has gone through the company and brand Hoka. Hoka has since 2015 grown at a compound annual growth rate of 42%, and they have grown from only being 3% of the total revenue in the revenue of Deckers Outdoor into now being 39% of the total revenue from Deckers Outdoor. This is incredible, and one of the main reasons why this has become such a household name is because it's a really good product, and I can see almost every sports enthusiast using their brands. And Hoka, and where I live in Norway, I also see other brands that Deckers Outdoor own, such as Uggs, which is really a household name in Norway and many use it, me myself. And for that reason, I thought I want to do more research on this company. So I would like to go through some of the quarterly reports that they did in last quarter, and show you some of the key numbers that they have gone through. And because of this amazing quarter, they rose 14% on the news that they beat expectations by $2. And the expected earnings per share was $3, and they beat incredibly huge. As you can see, they beat the estimates of 67% and the revenue of 8%. So that is incredible that they are continuing to beating the analyst expectations. So I would like to go through the companies through Simply Wall Street and share my thoughts on this incredible stock. So first off, if we look at how it's performed compared to the industry, you can see that it's almost beat every single metric. It's beat the overall US market, it's beat the luxury market, and it also has beaten many other industries because it's delivered 122% gains over the last year because of the incredible growth in Hoka and their continuous market share. They're continuing to take market share over competitors. So this is a bit about how the earnings and revenue is developing. You can see that for every dollar they make, they get to keep 17% of that. So for every sale they do, they get to keep 17% after all the expenses and all the investments and different stuff like that. So it has a really healthy net profit margin, and it's also a really good and effective business because its gross margin is 55%. So that is the revenue minus the cost of revenue. So they have a lot of room for research and development and continuing to take market share, advertisements. They have a lot of flexibility in their business, so they can continue to buy out competitors. They can continue to do a lot of research and development, improve their products to continue to take market share. And that is one incredible advantage that this company has compared to many others. If we look a bit about the earnings, it currently trades at a 35 price to earnings ratio, which is on the higher side, but for the growth that they've shown in the couple of years, it's incredibly cheap compared to software companies and other things like that. If we also look at the forward PE, this is based on the forecasted earnings in the next 12 months. It's trading at 33, which is about a 3.3% yield. It also trades at 6.2 price to sales ratio, which is not too bad, but it's also expensive for a shoe company and a retail brand. So if you compare this to other companies and brand and household names, you can compare it to like Crocs and other companies like Birkenstock. You can see that it's in the middle based on these 5 companies, based on the price to earnings. But I also think that paying high price to earnings on a good company is a lot better than paying very little for a bad company. You can also see that the stock has had some multiple expansion during the last 4 or 5 years. It has gone from like a 19 PE to now trading at a 35. But that is also because they have increased their profit margins and earnings higher than expected. So they have continued to beat the analyst expectations. So for that reason, they deserve a higher multiple than they have had in the past. Because you can see that it was really stagnant growth from 2013 to 2019. You can see that they only grew their earnings from 112 million US dollars and an 8% profit margin. In 5 years later, they only made, let's take this quarter for example, they only made 150 million with the exact same profit margins. So they had gone through a really stagnant phase where they didn't really grow. And in the last couple of years, after they've seen their continuous growth of brands like Hoka and Uggs, they have started to increase their profit margins. The profit margins growing every single quarter almost, and they have continued to accelerate their revenue and earnings for that reason. So that is a really, really good sign that something great is happening with the company, because it's continuing to accelerate the earnings after a really poor period of owning the stock and also being the owner of the company. It would be really bad to see this period where they had really no growth, and now they are continuing to take market share in the last couple of years. And every time I go to the gym, every time I train, I see people use Hoka, and that is because it's become one of the main competitors in the sports industry market. So they also, I would like to show a little about the free cash flow and how that is counted. So they have earnings as shown here, and they have a little, almost no depreciation and amortization, and almost zero stock-based compensation. And they also use a lot of money on investments and stuff. So for that reason, the free cash flow will, and I think something is wrong here, because this shouldn't show zero. But if we take this for example, we can see that they don't really have a lot of stock-based compensation, because if we compare it to like Palantir, which has really a lot of stock-based compensation, you can see that the free cash flow is also is always above the earnings. This is not the case in Deckers Outdoor. You can see that it's almost near the earnings every time. If we also look a bit about the metrics that I've talked about in the past episodes, we can see that they have some incredible profit margins and earnings, earning on capital employed, and return on assets and return on equity. So these metrics, these financial metrics, shows that the business is in a really healthy state currently. They are beating the industry in returns on assets in their industry, which is the sporting brands. So they have a 23% return on assets and 38% return on capital employed and 36% return on equity. If we compare this to a company like Nike, for example, you can see that the company has better metrics, financial metrics, than companies like Nike, and for that reason, I think that this company continues to have the ability to take market share, because they can make more money on $1 they spend in the company. So for every dollar they have in assets, they make more money on these assets. So for that reason, Deckers Outdoor can be less capital intensive than, for example, Nike, and continue to grow and take market share with less money. And that is also a reason why I believe that this company is so good, because of this capital light and capital, it's not capital intensive. They don't need to use a lot of debt to fund their operations, and that is the reason why the cash is just continuing to going steady upwards. And currently they have 1.5 billion in cash reserves, which is incredible and is really good for having the ability to buy out competitors. They also have ability to buy new research and development for new brands, and to create more products that the customer would like. And for that reason, I really love this, because I really like companies without debt, because that really shows that the business is healthy and they don't really need to use other people's money to expand and take market share, which is a sign that the company is continuing to take great decisions financially, and thinks about the longevity of the company. So that is the reason also why the analysts expect them to start paying dividends soon, because of this stable financial structure and the stable earnings history that they have. For that reason, it could start paying dividends, but currently it has incredible metrics, and they don't really need to pay out the dividend because they can return the better, use this money better in the business because they're making 38% on every dollar they spend in the business. So yeah, that just shows that this is a lot better than paying sorry, something fell out. Paying a dividend to an investor, which can maybe make like 11 to 12% on this on a new investment, but they can instead use this money and pay and make 38% on that money. So this is a extreme value generator for the investor that they continue to keep and reinvest into the business. If we also take a bit of look on the management, we can also see that they are not getting incredible stock-based compensation, and they also see that the salary is really stable, which shows that the company is really taking care of the shareholder and not only the owners of and the CEOs of the company. You can see the yellow graph showing how the earnings are growing a lot faster than the compensation that the CEO is making. So that just really shows that the Deckers Outdoor care about the investors in the company and the owners. So this is how Deckers have grown from a really small company to becoming this crazy competitor to many brand names that is really known for everyone. And I really believe that this company will continue to beat analyst expectations, such as they did in the last quarter. They continue to grow at 18%, and their diluted earnings per share grew 51%, which is incredible. And they're still guiding incredible growth. So for that reason, I will continue to hold this company. I believe that this company will continue to do me good in the future. You've seen some of my thoughts on the company, and this is a really new position for me, because I really have seen the opportunity that the company has and the competitive advantages that they have. And for that reason, I think that this will continue to beat the market, such as it's done in every time frame, basically, and is a lot superior than many other companies that is in its business. But some negatives about the company is that it's a really competitive industry. They have competitors such as Lululemon and Nike, which are really high known brand names. You can see companies like Lululemon and others losing the battle to Deckers Outdoor. But if they don't continue to beat these companies, you could see that the company could take a beating based on that they are not delivering based on the expectations that the analysts has put on the company. So yeah, thank you for watching this company. I have gone through Deckers Outdoor and what an incredible company it is. It did really well on Friday because of the beat on the quarterly report that they delivered. I really love the company, and I believe that it will continue to generate enormous returns for the investors. And if you have some thoughts about the company and something I didn't mention in this video, please go ahead and leave a comment under where you can share your own thesis on the company, but also just share any other thoughts about other companies that you have in your portfolio that you would like me to take a look on. So for that, I would like to thank you for watching, and I'll see you guys very soon. Thank you.